Hi friends, before I start this video, I want to take a minute and want to say big thank you to all of you who have viewed, commented, shared this particular video that I released just few days back. A massive thank you to all of you. Your comments and your support have lifted my spirits very high, and I'm back recording this video for you. And just before I start this video, I also want to say that so far I have not received any meaningful updates from either the YouTube support team or the government entity that had filed the legal complaint. I really do not know what was the issue with my 89 videos. They are not yet back. So I'm hoping that this video continue to reach to the wider audience so that at least I get some clarity on what was the issue on my 89 videos. With that spirit, let's get to this video here, and I want to start this video with some data. Have a look at my screen and you will see that in the last 1 month, Sensex is down by close to 5.45%. If you look at Nifty, it is down by almost 6%. I'm recording this video on 29th of October morning time, just when the market has started. So this data is as of 29th of October, but no matter when you are watching this video is going to be very useful whenever your portfolio is down. Now coming back to why this correction that we have seen in the last 1 month is a significant correction, have a look at this data that was published by ET, and this was the worst monthly fall in Sensex since 2020. So if you look at March 2020 and February 2020, this is where the Sensex dropped by the highest point. In March, 23%, in February, 6%, and right now when I'm recording this video, we are almost about to finish October and we are still down by 5.45%. But more interestingly, it's not just about 5% fall in the overall broader market. What I am seeing right now is that individual portfolios are down by maybe more than 5%, maybe 10%, 15%, 20%. I know a few people whose portfolios are down by even more than 20%. This is mainly because the broader markets have corrected by 5 to 6% as of now. But if you look at the individual stocks across the sectors have gone down by maybe 20%, maybe 30%, maybe 40%, right? So there is a huge correction at the individual stocks level, and that is why the portfolios that people are seeing that has come down more than 5%. So in such times, what are the strategies that people can use and apply is what I'm going to discuss in this video. With that, people who don't know me, my name is Rahul Jain. I'm a full-time investor and a full-time content creator. I also post in-depth analysis of various assets on a daily basis on my YouTube member community. If you're not yet a member, please consider subscribing because you're going to learn a lot practically. With that, let's get this video cracking. So the first option whenever your portfolio is down is to do nothing. Now allow me 2 to 3 minutes of commentary and I will give you my views of what are the pros and cons of this particular approach. So before I show you some data, first thing that you need to know is that whenever the markets are down, there are multiple variables that are bringing the market down, and one of them is the FI selling. Have a look at my screen and what you will see is that in the month of October, so far more than 1 lakh crores worth of cash or equities have been sold by FIIs in the market. And almost every single day, if you look at the pattern here, throughout the October period, you will see that the FIs have been selling almost every single day here, and DIs on the other hand have been buying the equities in Indian market. They have bought so far 98,000 crores of equities in Indian market. So there seems to be a tug of war going on between FIs and DIs in terms of the selling and buying, and that of course is creating pressure on Indian stock market right now. Of course, this is not the only factor. There are many other variables that might impact the stock prices in the short term, but this definitely is one of the reasons where the Indian stock market is getting a hit. But the million-dollar question is that up until what time this is likely to play out? And the good answer is that I do not know. Even the experts do not know, and forget about experts, even the FIs have no clue when are they going to return back to Indian stock market. But to be honest, we shouldn't be worried about when will FIs come back to Indian stock market, because that is not under our control. But more importantly, have a look at this data. You will see that in the last 4 years, 21, 22, 23, 24, FIs have been a net seller in the Indian stock market, and you will still see that Nifty has managed to give positive returns, right? So it is not that even if FIs do not return to Indian stock market, it is not that Nifty is not likely to give positive returns, but there is a correlation. So if you see 2022, FIs did net selling of 2,78,000 crore in the year, and here Nifty managed to give only 4.32% returns versus something like 2023 when they only sold 16,000 crores. Nifty rose by 19% almost. So the point I'm trying to drive home is that if you wait and do nothing, it is likely that sometime in the future FIs may come back to the Indian stock market, and there may be some buying by the FIs, and that's where the stock prices may go up. Your portfolio may look much better than where it is right now, and that is one of the benefit of doing this approach. What is the other side or downside of this approach? Let me also speak about that. The key downside of this approach is a concept called time correction. Again, let me give an example to make this point very, very clear. Let's say you buy a particular stock at 100 rupees price today, and after 3 years the price of that stock hypothetically, let's say, remain 100 rupees. So although the price of the stock has not corrected in the 3 years of time period, it still remains 100 rupees. But what has happened here is that the price also has not appreciated, right? Even if you put this 100 rupees in an FD, this 100 rupees in the 3 years time frame, if I take 7% rate, would have become 121 rupees. But now, because the stock has done something called as time correction, the price remains 100 rupees. This is the concept of time correction. So if you do nothing with your portfolio, the downside of that might be that you might see a time correction. It may be only for few days, it may be only for few weeks, it may be for months, and it might be for years. Unlikely it might be for years, but that's the downside. You need to understand that you might need to sit and wait patiently for the markets to correct, your portfolio to become greener, and therefore during that time period you are likely to see something called as time correction. The second option is downward averaging. Again, I'll take an example to explain the entire concept, but the broad concept here is that when your portfolio is down, what you do is you typically look at your portfolio, find the assets that you believe in, and because there is a correction, you start to invest more in those assets because you believe in those assets. Again, let me give you a very, very simple example to bring it to life. For example, let's say you have a stock and you have stock XYZ in your portfolio. Let's say you bought one quantity of this stock at a price of 200 rupees, right? And let's say at that time the PE ratio of this stock was 40. So the PE was on the higher side. It was potentially a overvalued stock, and let's say the PE was 40. Now let's assume that this stock corrects by almost 50%, right? And that is what is right now happening with many other stocks. So let's say that this is what exactly happens, that the price of this stock comes from 200 rupees to 100 rupees. Now let's assume that the EPS, the earning per share of this particular stock, is 5 rupees, right? And let's say when this correction of 50% happens, what happens to the PE ratio now? The PE ratio also now will come down to 20 because the prices have corrected, right? What is the formula of PE? PE is simply price divided by earning per share, right? So as a result of this 50% correction, the PE of this stock might have come down to, let's say, 20. Now, as part of the downward averaging, if you believe in this stock, again, I'll talk about how do you believe in a stock. What you might do is that you might go ahead and buy one more quantity of this particular stock. And let's say if you do that, your average price now will become how much? 200 plus 100 divided by 2, 150 rupees. For you, the average buying price is now 150. And for you, the average PE ratio at which you bought this stock will be how much? 30. 40 plus 20 divided by 2, 30. Now you sit and wait and you see 3 years later, very much similar to what we see in Bollywood movies or Hollywood movies, 3 years later. Now let's say what happens with the company is that in 3 years time, the earnings or the profits of this company continue to grow. For example, the EPS was 5 earlier. Let's say in the second year, the PE goes to, let's say, 7, right? Again, in the next year, the PE, let's say, goes to 10, right? So the earnings of this company is growing, and this is what precisely I mean by whether you believe in this stock or not. So if a company's earnings are growing and are likely to grow, and this is the analysis you might need to do, and for you, the PE now will become 150 because that was your average price that you bought it after downward averaging. And if the earning per share is 10, you divide it by 10, you get to a PE of 15, right? Your buying PE now becomes 15. And you know what? The price of the stock might go up or down, we don't know. But if I take a hypothetical example of the prices would have gone up in the 3 years of time period, the PE now will become 30 maybe in the market, or might be 20. or might be 25, right? And this is where now you're holding an asset that is undervalued from your buying purchase perspective, and this is the benefit of the downward averaging, that you did downward average from a 40 PE to 20 by investing a bit more. And this is where the concept of downward averaging creates value for you, that if you believe in assets and if you are okay to hold them for a longer period of time, this will make your assets more valuable in your portfolio. But this, I can tell you, is the hardest thing to do, because when markets are falling, theoretically it sounds very good to downward average, but you need conviction in order to be able to downward average, because it's not easy at all. When stock prices are falling, portfolio is down, you are able to buy more. It is extremely hard, but this is where the concept of downward averaging comes. Then comes option number 3, which is to start cutting your specific positions gradually. I know it is extremely hard to book the losses. It's not easy at all for an investor, because you take a lot of risks and you invest your money thinking that you are going to gain some, but there are instances where the opposite might happen, and this is extremely painful at times. So when should one start thinking about cutting their positions in a particular asset or a stock? There are potentially 3 reasons that a stock might go down. Might be a sentimental reason, might be fundamentals are deteriorating or reducing, or there may be a valuation concern. It might be a combination of all 3. Now let me take an example of this. So if I look at the Nifty during the COVID time, when we were in the month of February and the lockdown news started to come out, at that time, if you see, within the few days the Nifty dropped by almost 10%. So by 6th of March it dropped down by around 10%, right? Now at that time, some people might want to exit from Nifty index positioning because it's already down by 10%, and they can see a lot of sentimental fear, little to do with valuations here, but more to do with the sentimental issues in terms of the lockdown and how the businesses may not perform, etc. It is prudent to cut down your positions if you feel so, because then what you're not doing is you're not allowing your capital to come down all the way here. You don't know where the bottom might be. It is extremely hard to judge the bottoms. Therefore, it is important to think about sentimental, fundamental and valuation aspects of the asset and make your decision, right? Another example I can give you from a valuation and sentimental perspective is CPSE index, basically an index that represents PSU businesses. If you look at the valuation right now, the PE ratio of this index is 13.1, and if I look at the last 5 years of average PE, that is 9.06, highest it has gone into 15.41. Now if you look at the PE chart of this particular index, what you will note is that here 1st of August, the PE ratio was 15.41, the highest, right? And now the correction has started in this particular index. At the time of recording this video, the PE has come down to almost 13. Now it is still on the higher side from a 5 years average long-term perspective, and therefore one might say that it might still come down further, and therefore they might want to cut the positions. Again, I'm not saying that go and sell off your PSU positions. Of course not. This is at index level. You will have to evaluate the specific stock that you hold, look at the earning potentials for the next 2 to 3 years, look at the valuations, and if you think that earnings can catch up with the valuations, you might not decide to sell the stock off. But if you think that the valuations are still too high, the earnings are not growing at a rate that you would like, and you're not ready to wait for another 2 to 3 years of time, then at that time cutting your positions may make more sense. And secondly, if you do not have expertise in terms of understanding whether the stock or the asset is likely to go down, please consult a financial advisor. Do not make the decision independently. Your financial advisor might be able to give you better choice, better options. And the third choice that you might have is that you might start to go down a route of stop losses, blind stop losses of maybe, I don't know, 8%, 10%, 5%, because you know that you can't really judge the bottom. Whenever your asset is down by, I don't know, 8 to 10%, you might say that, you know what, I have a very blind stop loss that if my asset is down by 10%, I exit and book my loss and I look for other opportunities to make money. So there are various possibilities here that you can consider if your portfolio is down. So in this video, what I've done is I've given you options, pros and cons, and a point of view that you might want to go and explore further. Please do not take this as a financial advice. This is purely for educational purposes. And if you like this video, hit the like button. Let me know in the comments a simple thank you. You can also consider joining my YouTube member community if you want to learn practically from stock market, because I post almost on a daily basis. With that, I hope to see you in my next video. Until then, keep rocking.